Ray Martin and Erica Hill, who are over here. This has been one of those weeks where so many people have been writing in emails wondering what to do. Not only a financial expert, but I guess it's fitting that we're here on the couch. Therapist this week is too, for a nation that's really in a panic.
Absolutely. So many people need this because we heard Jill talk about it a little bit with you, Chris, but what people really want to know is how is this going to affect me? So moving forward, for the average American, is the worst over?
Okay. Well, this plan by the Fed is a backstop, okay? There's nothing in here really that's going to help the economy move forward. This is going to prevent us from going over a cliff. In effect, these are Jersey barriers to keep the economic train from diving into a deeper abyss here. Now, that's okay. That'll stem the panic for a lot of people. What I've got to put my faith in is the people who put this plan together. Secretary of Treasury, Harvard MBA, Secretary of Treasury Paulson, 30-year veteran at Goldman Sachs, understands the market better than anybody else. And Dr. Ben Bernanke, MIT economics PhD, wrote a book, Essays on the Great Depression.
I was going to say specialty on the Great Depression, so that's what you want to hear.
This guy has lived his life for this moment. The best of America is in charge. We can take comfort in that.
But we've got you here, too, which is good for us, because you're the man who can help everybody at home. As Chris mentioned, a number of emails. Gary sent us this one. He says, my wife and I are moving some money into a money market account. Jill just mentioned these. Is that a safe place for them? Okay, for Gary, I checked out the Citibank Rate Accelerator money market account he's referring to. This is an FDIC insured money market account offered by Citibank. So he's going to have the FDIC insurance protection. It's one of the safest places to go. I also checked out with him that they're offering an introductory rate of 3.75%, which is a high rate. And that's why I said that's a concern. But since this is FDIC insured, that high rate is a teaser rate to get him in. So it's not indicative of high risk. It will fall. That rate will fall at the end of the year. So you should look at other alternatives like Zions Bank and HSBC for maybe higher ongoing rates.
Is that what everybody really needs to be aware of now? Make sure that there is some pocket of insurance. FDIC definitely. Don't put your money anywhere else.
Well, that's a distinction from insured money market account versus money market mutual funds, which are not insured, which is where the $3.5–4 trillion of cash is. Money market mutual funds are not insured yet, but the Fed's plan to insure them now should help people breathe easier. Don't panic. Don't bail out of your money market mutual fund now, because now there'll be some federal backing up to $50 billion. All
right. When it comes to stock, we also got an email from a viewer who has AIG stock. What happens now? Is it ever going to be worth anything?
Well, the stock traded Friday at about $3.85 a share. At the beginning of the year, it's $56 a share. The CEO said, look, we're now going to manage this company, sell off assets, hopefully pay off the federal credit line of $85 billion before the feds come in and have to take an equity stake. So it's likely that company's going to remain publicly traded, smaller but profitable. The stock could recover. I wouldn't sell it here now at this point. What are you going to get, $3 and change?
But worth holding on to for a little bit.
I think the people that work there, though, that had so much tied, it kind of goes back a la to Enron, where people have so much tied up in their company stock.
Chris, you bring up a great point. This is the moment now to talk about diversifying company stock in your 401k. If you buy stock through payroll deduction, don't do that. Diversify your money. Don't buy loads of a single share in a company. You'll lose your job and your savings if the company.
So diversify. And when it comes to stocks, though, is this actually a good time to be investing?
I think
is it safe yet?
I think you've got to wait for these Fed plans to come out, the markets to stabilize. Look for things like lower mortgage rates, more available mortgage liquidity and mortgage loans. Housing starts to recover. Housing prices to firm to stop falling. That has always led firm market recoveries. The next move with my clients' investable cash will be buying stocks. Not yet. I'm going to wait for things to stabilize, but I'm looking to put portfolios back together for people who have gone to cash.
So if you had to give a blanket tip to most people out there that have money in the market, in mutual funds, in their 401k, what would it be?
Here, you don't panic. Make sure you're diversified, not in specific areas of risk. Be broadly diversified. And where you're contributing, continue to contribute now. And look to buying stocks when things stabilize.
And no rash moves. Ray Martin, always a pleasure.